Hello, everyone. Welcome to our session today. Today, our topic is property investment with no cash outlay. So let's have a look how is that possible. Okay, before we go to the main content of this video, a quick declaration. The information provided is for general guidance only and should not be considered as personalized tax advice. We recommend consulting a qualified tax advisor or planner before implementing any tax planning strategies. Please note that we're not licensed financial planners and do not provide financial product advice. For tailored investment guidance, consult a licensed financial planner. All right, let's have a look at the main content. Okay, there's a common myth. Most people think that large savings are required to invest. The truth is, strategic planning allows investing with no upfront or ongoing cash. All right, then let's have a look at a few possible directions. Okay, first possibility, leverage existing equity. Okay, use equity in home investments as deposits. Avoid need for cash contribution. Let me give you one example. So let's say if I have a property that maybe the value on the market is $2 million. I have a 500K loan. Okay, that means I can potentially get a split loan out for 1.5 million from this property. And then if I can build up a split loan, potentially I can use a portion of that split loan to pay for my initial down payment for a new investment property, and also plus stamp duty, legal cost, valuation, basically all the initial costs related to purchasing this new investment property that can all be paid from this split loan from an existing property. All right, so that means you don't need to um, pay for anything by yourself from your own personal cash account. Of course, another advantage is it's going to help you to maximize interest deduction as well in the future. So that split loan you got out from an existing property, the balance, loan balance, or any interest incurred on that loan balance, you can also claim a tax deduction on this new property in the future. All right. Okay. Next possibility, 100% LVR lending structures. So basically, under those structures, you can borrow 100% plus purchase using multiple securities and structure. But of course, the structures are complicated. They do require expert guidance, and you also need to find a mortgage broker or a lending manager um, who can show you product or loan product that can allow you to utilize this structure. All right, so basically, you also need to have securities. So that means you have another property that already have enough equity built up. And then, but the difference is from the last possibility, this one you don't need to set up a split loan. So the new loan, they're 100%. The new loan is 100% related to the new property. Okay, so you don't need to set up a separate split loan, and it's 100% on this new property on the loan borrowing. All right. Um, tax deductible holding cost, that's more focused on the ongoing cash. Okay, so let's say if the rent plus your tax savings will cover most expenses, then you actually have minimal to no impact on personal cash flow. Actually, it's very possible if you talk to a buyer's agent, potentially they can introduce you to areas or properties that will give you positive cash flow. Positive cash flow, and then plus the depreciation deduction. Okay, you can actually get more tax back on the refund on the tax loss. Then it can be a positive cash flow and tax refund, but also no cash outgoing, okay, from year to year. Okay. And then trust and self-managed super fund. So you can potentially use your funding from family trust or super fund to invest. That's a possibility too. You can also use your personal security potentially, yeah, if it's allowed. You can potentially use a personal um, property as security to borrow loan as well. Okay, as a guarantor um, to borrow loan under a trust or self-managed super fund is more complicated. Yeah, but you can talk to uh, lending manager or a mortgage broker to organize loan as well inside self-managed super fund. But of course, you need to make sure that your cash flow is enough to cover the loan repayment. Okay, your super contribution and potentially income on other asset, other investment that's under the existing super fund. Okay, of course, one of the main advantages of utilizing a trust or self-managed super fund, it will help to protect assets and also optimize tax. Okay, trust is one of the best structures to help a family group to save tax. Self-managed super fund, the income is only 15% income tax. Okay, um, and the future capital gains tax is only 10%. So it's actually a great structure for tax saving. But of course, once your money is there, is kind of locked in there. You can only get the money out on compassionate ground or when you reach preservation or retirement age. Okay. Next one, government grants and incentives. So this one is mainly to help you to make sure you can utilize all possible strategies to minimize your own cash flow, even including your own borrowing from the bank, because that's still your own money eventually at the end of the day. All right. So initially, you should try to access first home buyer grants or stamp duty concessions as much as possible. Every single taxpayer inside Australia, before you buy your first property, you should consider okay, all the grants or stamp duty exemption, and also first home super saver scheme. So under this first home super saver scheme, you can actually contribute super and treat it as concessional super contribution to your super fund. And then after a few years, you can withdraw all the money out to pay for your down payment for your first home inside Australia. It's actually a very good strategy to save tax as well. Okay. And then, of course, all these strategies will help you to reduce or eliminate upfront costs. Okay, so try to utilize them as much as possible. All right. Then, of course, strategic property selection. This is also important. Okay, try to focus on high yield or dual income properties. Dual income properties are those properties that potentially got two separate dwellings or two separate entrance or separate buildings potentially. Basically, two families can potentially live in that property, like a house with a granny flat, separate granny flat in the backyard. That's potentially be a one-bedroom apartment or a bit like a studio apartment. Okay, you can actually earning two rental income from one property that's under one title. All right, and then also consider newer builds with depreciation benefits. So newer builds, they would have higher depreciation, yeah, in the initial years, of course, as everyone know already. But one thing you might want to consider is when you are buying something brand new, be careful, very careful on the quality of the building as well. Because for myself, my preference is normally, this is only my own preference. It's not like everyone have to do it that way. I'm sure people buy brand new apartment buildings and they're also good quality. But personally, my preference, I want to buy apartments that's more than 5 years old. Once they're settled already, if there are any defects, building defects, you can already see them. If there are cracks on the wall, then you know, okay, there are some serious issue. If there's leakage, you can look, like just have a look at the wall, have a look at the floor. you know there might be leakage before, then you can be careful. But when you're buying a brand new apartment, you might not be able to find or detect those building defects. Okay, so that's the issue. All right, minimize tax benefits. That's where we come in. Okay, we need to help you as well to do some analysis. Of course, most of our clients already know before you purchase any property, make sure you talk to us first. Yeah, we'll help you to do some calculations to see whether it's going to be positive cash flow and then what's going to be the tax benefit from year to year, because that's actually will help you to come in to complement or add back to your cash flow. Okay, every rental property, they should give you back another $8,000 to $10,000 refund potentially. Okay, so you can use depreciation schedules to claim maximize your depreciation, and also claim deductions to increase cash flow. Okay, there are a lot of tax strategies around here, so make sure if you're interested, book a consultation with us. Yeah, depreciation is one thing that's important. The reason why when you're considering cash flow, because depreciation is not a cash flow outgoing. You're not paying anything for depreciation. Okay, so but you can claim the deduction and then convert it to cash flow. It's going to be reflected on your tax refund. Okay, based on your marginal tax rate when you are generating a tax loss. If your rental income and all your other expenses are roughly matching each other, so you're making even when you don't consider depreciation. But when depreciation come in, you're going to create a tax loss. And that tax loss will help you to claim a tax refund on the rental loss based on your marginal tax rate. If your marginal tax rate is 47% and your loss created, let's say you have $10,000 depreciation, then $10,000 multiplied by 47%, $4,700. Okay, you can claim back as a tax refund. So that's how important depreciation is. Okay. All right, final thought. It's not about affording a property. It's about leveraging what you already have to build wealth. Okay, you don't have to have saved a lot of money to be able to buy your next property. You might be able to do it already. Think about it. But of course, you also need to consider risk. Yeah, what if the property market crack down? You also need to be careful. Yeah, make sure, in the financial planning side, you want to keep your eggs in different baskets, right? So that when there's risks, you are protected at least because you got other baskets of eggs that's still left with you. All right. Okay. That's everything I wanted to cover. Here is a brief introduction about myself. Also our contact details. If you have any questions, let us know. Drop us an email, give us a call, or if you're about to purchase or sell a rental property, make sure talk to us because there are so many mistakes that can be made that could cost you tens of thousands of dollars. So talk to us if you have any questions. All right, thank you. I'll see you in our next session.